Hi, my name is Kevin Feig, and I'm the founder of Walk You to Wealth. I wanted to spend just a few minutes talking about the Health Savings Account, or HSA. The Health Savings Account is one of the more misunderstood investment accounts, and also one of the greatest, if not, in my personal opinion, the greatest. It's the GOAT of all investment accounts. So the way this account works is it starts with a high deductible health plan, which has very little to do with your retirement and your finance. It has to do with your health insurance coverage. So a high deductible health plan will have its pros and its cons. The major pro is that it comes with a health savings account. It's also generally the cheapest option. The downside is that most of your medical expenses you'll have to pay for out of pocket to really get the full benefit. So I always like to think of the high deductible health plan as almost not having insurance. So your preventative care will generally be covered. All depends on your plan, but your preventative care, so think about an annual physical, generally covered. Anything else, you're going to pay for up to a certain amount. And again, every plan is different based on typically your employer, which is usually where most folks obtain their health insurance. But it all starts with signing up for a high deductible health plan. When you sign up for a high deductible health plan, you get access to a health savings account. And then you can contribute to that account. Sometimes your employer will also contribute, not dissimilar to a match on your 401k. That money gets contributed pre-tax, similar to a 401k, meaning if you contribute $5,000 into your health savings account in 2026, you don't pay income tax on that $5,000. It goes in pre-tax. Then you have the ability to invest those contributions. How much you can invest will vary based on your employer. Some employers require you to have a small amount of cash. Maybe it's $500 or $1,000. Some employers don't have that requirement, but you can invest a good portion, if not all, of your health savings account if you choose to. And your investment options will vary, again, based on your employer, similar to a 401k. Next, when you do go to the doctor for non-preventative medical expenses, to get the most benefit out of this account, you don't want to use it. The danger is that it's going to come with a debit card. And so folks think it's a spending account. It came with a debit card. Let me spend the money. Ideally, you don't spend the money. Ideally, what you do is you pay out of pocket. So you go to the doctor, you get a $200 bill, you pay out of pocket. So it's key to have additional cash on hand if you go down the health savings account route. Now you want to be patient. You want to let your investments grow. But now you get to the point of maybe you're retired. You can now use these proceeds tax-free for qualified medical expenses. And the real benefit is you can also reimburse yourself for qualified medical expenses from the past. So I'll use glasses. I wear glasses. If I bought these glasses in 2026 and I paid out of pocket, I paid with cash from my checking account, I didn't touch my health savings account. In 2035, I'm retired. I can now reimburse myself for those glasses tax-free. Now, I may use that money to go to the movies or go out to dinner, whatever. But the point is, because I have the receipt from 2026 for $200 for my glasses, I can now reimburse myself in 2035, take that $200 out tax-free, and use it on really whatever I want. So it gives you added flexibility. It gives you added flexibility if you save your receipts while you're under a health savings account, while you have a high deductible health plan. And if you save those receipts, it just gives you more flexibility at the end. Now, if you don't save your receipts, you will have no shortage of medical expenses in retirement. And this allows you to pay for those tax-free. It is the only account that is truly tax-free. Because if you remember from step 2, the money went in pre-tax. When you put in my example, that $5,000 in 2026, you did not pay income tax on that money. Much like a 401k. But different than a 401k, when you take out the proceeds from a health savings account, if it's for qualified medical purposes, it's also tax-free. So it's like a 401k on the front end and a Roth on the back end, if used for qualified medical purposes. It is the only account where you potentially will never pay income taxes. And that is why it is the GOAT of investment accounts. Hope that was helpful.
Disclaimer. The information in this video is provided for your convenience only and is not intended to be treated as financial, investment, tax, or other advice. The information is intended to be educational and is not tailored to the investment needs of any specific individual. It is also not intended to be relied upon as a forecast and is not an offer or solicitation to buy or sell any securities or to adopt any investment strategy. The opinions expressed are those of the author. Reliance upon the guidance and information in this presentation is at the sole discretion of the individual.